Evaluating long-term debt maturity schedules to assess surety risk exposure requires a detailed and methodical approach to understanding the financial obligations of a bond principal and their implications for liquidity, operational stability, and creditworthiness. At its core, a maturity schedule represents the timeline over which debt obligations are due for repayment, whether in periodic installments, bullet payments, or balloon structures. This schedule is a critical indicator of the principal's ability to manage its financial responsibilities, particularly in industries where cash flow generation can be volatile or seasonally dependent. The analysis begins with categorizing the principal's long-term debt by type, such as bonds, loans, or structured finance instruments, and understanding the terms of repayment, including interest rates, amortization schedules, and any embedded contingencies like call or put options. Each of these elements must be examined within the context of the principal's broader financial strategy and market environment. A key consideration in this analysis is the timing of cash inflows relative to debt servicing requirements. For example, a principal with a concentrated schedule of balloon payments, large lump sum repayments due at the end of a loan term, may face significant liquidity pressures if these obligations coincide with periods of reduced revenue or market downturns. Historical examples, such as the financial distress faced by corporations during the global financial crisis of 2008, illustrate how reliance on balloon payments can amplify risk. Companies that depended on refinancing their balloon payments found themselves unable to secure favorable terms or, in some cases, any refinancing at all, leading to defaults that had cascading effects on sureties and other stakeholders. This underscores the importance of assessing the refinancing environment and the principal's credit profile in conjunction with the maturity schedule. Factors such as interest rate volatility, lender sentiment, and macroeconomic conditions all play a role in determining the feasibility of rolling over debt obligations. Interdisciplinary insights can further enrich this analysis. From a corporate finance perspective, understanding the principal's capital structure provides context for their debt maturity strategy. A company with a high debt-to-equity ratio may exhibit greater sensitivity to shifts in borrowing costs, while those with diversified financing sources might demonstrate more resilience. Meanwhile, behavioral finance sheds light on the decision-making processes of corporate treasurers and financial officers, particularly their risk tolerance and tendencies to prioritize short-term gains over long-term stability. Historical and cultural contexts also influence these decisions. For instance, firms in economies with a tradition of high leverage may view aggressive debt schedules as normal, while those in more conservative financial environments might avoid such practices altogether. Beyond the timing of payments, the scale of obligations relative to projected cash flows is another critical dimension. Analyzing financial statements to forecast cash flow coverage ratios, such as the ability of operating income to meet interest and principal payments, is a foundational step. However, this analysis must account for potential disruptions, such as unexpected expenses, shifts in consumer demand, or regulatory changes that could strain resources. For example, consider a construction firm serving as the bond principal on a large public infrastructure project. If its long-term debt maturity coincides with unforeseen cost overruns or delays, its ability to meet obligations may be compromised, creating exposure for the surety. To mitigate such risks, sureties often scrutinize the flexibility built into the principal's financing arrangements. Covenants and terms that allow for early repayment, restructuring, or access to revolving credit lines can serve as buffers against liquidity crises. Conversely, restrictive covenants that limit asset sales, cap leverage ratios, or enforce strict repayment schedules may constrain the principal's ability to adapt to adverse conditions. For this reason, a nuanced understanding of the contractual terms governing debt is essential. This involves not only reading the fine print, but also assessing the historical enforcement of these terms by lenders. Case studies have shown that creditor leniency, or the lack thereof, can significantly impact a firm's financial health during periods of stress. The theoretical framework underpinning this analysis includes principles of risk management, such as the identification, quantification, and prioritization of potential threats. Modern portfolio theory, for instance, can be adapted to evaluate the risk-reward trade-offs in a principal's debt profile, balancing the cost of capital against the stability of cash flows. Similarly, Concepts from game theory may be applied to model interactions between the principal and creditors, especially during negotiations for refinancing or restructuring. These theoretical approaches are complemented by practical tools, such as stress testing and scenario analysis, which simulate the impact of adverse conditions on the principal's ability to meet obligations. Stress tests might examine scenarios like a sharp increase in interest rates, a decline in revenue, or a delay in anticipated receivables, providing a probabilistic assessment of default risk. Contemporary debates in this field often center on the role of regulatory frameworks and their impact on debt management practices. For instance, Basel III requirements for banks have influenced lending standards, pushing principals toward alternative financing mechanisms that may carry their own risks. Similarly, discussions around ESG, environmental, social, and governance criteria are shaping the landscape of corporate debt issuance, with investors increasingly demanding transparency and alignment with sustainable practices. This trend adds a layer of complexity to the analysis, as sureties must consider not only the financial, but also the reputational risks associated with a principal's debt portfolio. In conclusion, evaluating long-term debt maturity schedules for surety risk exposure is a multifaceted exercise that integrates financial analysis, theoretical insights, and practical applications. It requires a deep understanding of the principal's financial position, the broader economic environment, and the dynamics of creditor relationships. This analysis not only informs underwriting decisions but also contributes to the broader goal of fostering stability and resilience within the surety and financial ecosystems. By maintaining a rigorous and adaptive approach, analysts can navigate the complexities of this critical aspect of risk management. Analyzing off-balance sheet liabilities in complex surety underwriting is a critical endeavor that requires a detailed examination of financial disclosures and a deep understanding of the hidden risks that may not be readily apparent in standard financial statements. Off-balance sheet liabilities, by their nature, represent commitments or potential obligations that do not appear as formal liabilities on the balance sheet but can have significant implications for a principal's financial health and overall risk profile. These liabilities include operating leases, guarantees, joint venture obligations, contingent liabilities, and other contractual commitments that, while technically off the balance sheet, can materialize into real financial burdens under certain conditions. Such liabilities distort a company's apparent financial stability, creating challenges for underwriters tasked with assessing the true level of risk associated with bonding the principal. To begin, operating leases have historically been one of the most prominent sources of off-balance sheet liabilities. Before the implementation of recent accounting standards like ASC 842 and IFRS 16, operating leases allowed companies to keep significant long-term commitments off their balance sheets, understating their leverage and inflating financial ratios such as return on assets. Underwriters must carefully analyze the terms of these leases, particularly their duration, escalation clauses, and termination provisions. For example, a company heavily reliant on long-term leases for critical operational assets such as manufacturing facilities or transportation fleets may face severe liquidity pressures if economic conditions deteriorate or lease costs increase. Even with the new accounting rules requiring many leases to be capitalized, nuances in disclosure and classification still demand vigilance. For instance, certain short-term or low-value leases may remain off the balance sheet, yet collectively pose substantial risks. Guarantees represent another significant category of off-balance sheet liabilities that underwriters must scrutinize. These obligations can arise from a variety of arrangements, such as financial guarantees for subsidiaries, indemnities provided to third parties, or commitments to support joint ventures or affiliates. A key challenge lies in assessing the likelihood and magnitude of these guarantees being triggered. Historical case studies, such as the collapse of Enron, illustrate how undisclosed or poorly understood guarantees can lead to catastrophic financial outcomes. Enron's use of special purpose entities and complex guarantee structures obscured its financial risks, ultimately resulting in a crisis that reverberated through financial markets and highlighted the importance of thorough due diligence. In surety underwriting, guarantees associated with joint ventures often require particular attention, as the principal may be jointly and severally liable for obligations incurred by the partnership. This means that the surety could be exposed to risks beyond the principal's direct operations, including those arising from the financial or operational mismanagement of joint venture partners. Joint ventures themselves present unique challenges in the context of off-balance sheet liabilities. While joint ventures can be strategically advantageous, allowing companies to share resources, expertise, and risk, they often involve complex contractual arrangements that create contingent obligations. These may include funding commitments, performance guarantees, or obligations to cover shortfalls if the venture underperforms. For instance, in the construction industry, joint ventures are common for large infrastructure projects, but their financial structures can be intricate, involving multiple layers of guarantees, back-to-back agreements, and indemnities. An underwriter must evaluate the terms of these arrangements to understand the full extent of potential liabilities. This includes analyzing the financial health and reliability of all joint venture partners, as well as the governance mechanisms in place to mitigate conflicts and ensure accountability. The theoretical framework for analyzing off-balance sheet liabilities integrates principles from financial accounting, risk management, and behavioral finance. From an accounting perspective, the concept of substance over form is paramount. Underwriters must look beyond the formal classification of liabilities to understand their economic substance. For example, a lease classified as an operating lease may functionally resemble a loan if it includes fixed payment obligations and transfer of ownership at the end of the term. Risk management principles, such as scenario analysis and stress testing, are essential for modeling the potential impact of off-balance sheet liabilities on liquidity and solvency. Behavioral finance adds another layer of insight, shedding light on how managers' incentives and biases may lead to underreporting or obfuscation of liabilities. For instance, executives motivated by performance metrics linked to balance sheet health may structure transactions to minimize visible liabilities, even at the expense of long-term financial stability. The practical application of these analyses involves a meticulous review of financial disclosures, footnotes, and management discussions in financial reports. Underwriters must also leverage external sources, such as industry benchmarks, credit reports, and market intelligence, to corroborate or challenge the principal's representations. Contemporary debates often center on the adequacy of disclosure requirements and the effectiveness of regulatory frameworks in capturing off-balance sheet risks. Critics argue that despite advancements in accounting standards, significant gaps remain, particularly for contingent liabilities that depend on subjective estimates of probability and impact. This underscores the importance of supplementing financial analysis with qualitative assessments of the principal's governance, risk culture, and operational resilience. Incorporating interdisciplinary perspectives can further enhance the analysis of off-balance sheet liabilities. For example, insights from contract law are invaluable for understanding the enforceability and implications of guarantees, indemnities, and other contingent obligations. Similarly, concepts from organizational psychology can help underwriters assess the risk management capabilities of the principal's leadership team, including their ability to identify, quantify, and mitigate hidden risks. Technological tools, such as data analytics and artificial intelligence, are increasingly being used to analyze large volumes of financial and operational data for patterns indicative of hidden liabilities. These tools can identify anomalies or inconsistencies that may signal undisclosed risks, providing a powerful complement to traditional underwriting methods. Contemporary examples of off-balance sheet liabilities with significant implications for surety underwriting include environmental remediation obligations, litigation risks, and pension liabilities. Environmental remediation, for instance, often involves contingent liabilities that are highly uncertain in both timing and magnitude. Underwriters must assess the potential for regulatory changes, legal actions, or unforeseen events to trigger these obligations. Litigation risks, particularly in industries with high exposure to legal disputes, can also create substantial off-balance sheet liabilities. Pension liabilities, while typically disclosed in financial statements, often involve actuarial assumptions that can obscure the true scale of obligations. For example, overly optimistic assumptions about investment returns or employee longevity can understate the liability, exposing the surety to greater risk than initially apparent. By maintaining a rigorous and comprehensive approach, surety underwriters can effectively identify and assess the impact of off-balance sheet liabilities, enabling more informed decision-making and risk mitigation strategies. Through a combination of detailed financial analysis, theoretical insights, and practical tools, underwriters can navigate the complexities of these hidden risks, ensuring that the principal's financial health is accurately represented and that potential exposures are fully understood. This process not only protects the surety, but also contributes to the broader goal of fostering transparency and stability in financial markets. Cash flow waterfall models are critical tools in financial analysis, particularly in the context of prioritizing payments under stress. These models outline the hierarchy of cash distributions, specifying the sequence in which creditors, equity holders, and other stakeholders receive payments during both normal operations and distress scenarios. At their core, waterfall models serve to enforce contractual obligations, ensuring that the highest priority claims, often senior debt, are satisfied before residual cash flows are allocated to lower priority stakeholders. Understanding these mechanisms is essential for assessing a principal's ability to honor bond obligations, especially when resources are constrained. The structure of a cash flow waterfall provides valuable insights into the resilience of the principal's financial position, highlighting potential vulnerabilities that could exacerbate liquidity pressures in times of distress. The foundation of a cash flow waterfall lies in the concept of payment seniority, which is dictated by contractual agreements such as loan covenants, bond indentures, and shareholder agreements. These agreements define a clear order of precedence, starting with operational expenses and moving through various tiers of creditors, from secured and unsecured lenders to subordinated debt holders and, ultimately, equity investors. For example, in structured finance arrangements like collateralized loan obligations or real estate investment trusts, the waterfall explicitly delineates how cash inflows are distributed to different tranches, with senior tranches receiving payments first to minimize their risk exposure. This prioritization reflects the risk-return trade-off inherent in financial markets, where higher seniority often correlates with lower yields due to reduced risk. However, in distress scenarios, even senior creditors may face partial or delayed payments, underscoring the importance of evaluating not only the structure, but also the sufficiency of cash flows to meet obligations. From a theoretical perspective, the prioritization within a cash flow waterfall is rooted in principles of creditor protection and contractual enforceability. Legal frameworks such as bankruptcy laws and the Uniform Commercial Code establish the rights of creditors in insolvency proceedings, reinforcing the hierarchy defined by the waterfall. For example, secured creditors typically have a first claim on collateralized assets, while unsecured creditors must rely on residual cash flows after senior claims are satisfied. This legal infrastructure provides a degree of predictability, enabling underwriters and other stakeholders to assess risk based on the expected recovery hierarchy. However, the rigidity of these frameworks can also create challenges, particularly when cash flows are insufficient to cover all claims. In such cases, intercreditor agreements and restructuring negotiations play a critical role in determining how shortfalls are allocated. Practical application of cash flow waterfall models involves detailed analysis of the principal's financial projections and historical performance. Underwriters must evaluate the consistency and predictability of cash inflows, focusing on factors such as revenue cycles, cost structures, and working capital management. Stress testing is a key component of this analysis, simulating scenarios where revenues decline, costs escalate, or unexpected obligations arise. For instance, in the context of a construction company serving as the bond principal, delays in project completion or disputes over payment milestones could disrupt cash flows, triggering cascading effects within the waterfall. Similarly, in industries with cyclical revenue patterns, such as retail or manufacturing, seasonal fluctuations must be incorporated into the model to assess the principal's ability to meet obligations during low revenue periods. A critical dimension of this analysis is the identification of potential bottlenecks or vulnerabilities within the waterfall structure. Balloon payments, excessive reliance on short-term financing, or significant obligations to junior creditors can create pressure points that amplify risk under stress. Additionally, contractual terms such as cross-default clauses or acceleration provisions can exacerbate liquidity challenges by triggering simultaneous claims from multiple creditors. For example, if a principal defaults on a subordinated loan, cross-default provisions may allow senior creditors to demand immediate repayment, effectively disrupting the waterfall's intended sequence. These dynamics highlight the need for a comprehensive understanding of all contractual relationships and their potential interactions under distress conditions. Interdisciplinary perspectives further enhance the analysis of cash flow waterfall models. Insights from behavioral finance shed light on how decision-makers within the principal's organization prioritize payments and allocate resources under stress. Cognitive biases such as optimism, bias, or loss aversion can influence these decisions, potentially leading to suboptimal outcomes. For instance, managers may prioritize short-term survival over long-term stability, diverting resources away from critical obligations to address immediate pressures. Organizational psychology also plays a role, as the internal governance structures and accountability mechanisms within the principal's organization impact the execution of the waterfall model. A well-governed organization with robust financial controls is more likely to adhere to contractual priorities, while weaker governance increases the risk of misallocation or fraud. Technological advancements are transforming the application of cash flow waterfall models, particularly in the realm of data analytics and predictive modeling. Machine learning algorithms can analyze historical cash flow patterns to identify trends and forecast future performance, providing underwriters with more accurate and granular insights. These tools also enable real-time monitoring of cash flows, allowing for early detection of deviations from expected patterns and proactive risk management. For example, advanced analytics might flag anomalies in accounts receivable collections or identify shifts in customer payment behavior that could impact cash flow availability. By integrating these technologies into the underwriting process, stakeholders can enhance their ability to assess and mitigate risks associated with cash flow prioritization. Contemporary debates in this field often center on the balance between flexibility and enforceability within cash flow waterfall models. On one hand, rigid adherence to predefined hierarchies provides clarity and protection for creditors, ensuring that their rights are upheld in distress scenarios. On the other hand, flexibility is essential for navigating complex situations where strict enforcement of the waterfall could exacerbate financial distress or lead to suboptimal outcomes. For example, during the global financial crisis of 2008, many restructuring agreements involved deviations from standard waterfall priorities to achieve broader consensus among stakeholders. These cases highlight the tension between legal frameworks and practical considerations, raising questions about the optimal design of cash flow waterfalls in diverse contexts. Historical examples further illustrate the significance of cash flow waterfall models in shaping financial outcomes. The bankruptcy of Lehman Brothers in 2008 revealed the complexities of prioritizing payments in a highly interconnected financial system, where multiple layers of creditors and counterparties had competing claims. The subsequent resolution process underscored the importance of clear and enforceable waterfall structures, as well as the challenges of navigating unanticipated interactions between contractual obligations. Similarly, in the municipal bond market, cases of fiscal distress in cities like Detroit and Puerto Rico have highlighted the role of cash flow waterfalls in determining recovery rates for different classes of bondholders. By maintaining a rigorous and detailed approach to analyzing cash flow waterfall models, underwriters can gain a comprehensive understanding of the principal's ability to navigate financial stress and meet bond obligations. This analysis integrates financial projections, legal frameworks, technological tools, and interdisciplinary insights, creating a robust foundation for risk assessment and decision-making. Through continuous refinement and adaptation to evolving market conditions, cash flow waterfall models remain a cornerstone of effective financial analysis in complex underwriting scenarios. Interpreting working capital trends requires a nuanced understanding that extends far beyond the calculation of simple ratios such as the current ratio or quick ratio. While these metrics provide a baseline snapshot of liquidity, they often fail to capture the intricate dynamics of current asset and liability trends that influence short-term financial health. Anomalies such as cyclical inventory buildups, deferred liabilities, and uneven receivables collections demand a deeper investigation to assess their underlying causes and implications. Working capital, at its core, represents the net resources available for day-to-day operations and reflects a delicate balance between operational efficiency, market conditions, and financial strategy. Understanding these trends requires not only quantitative analysis, but also a contextual interpretation of the company's operating environment and financial practices. Cyclical inventory buildups are among the most significant anomalies affecting working capital. These buildups can arise from seasonal demand fluctuations, supply chain disruptions, or strategic decisions to capitalize on bulk purchasing discounts. For example, a retailer might intentionally increase inventory levels before the holiday season to meet anticipated demand spikes, which would temporarily inflate current assets and reduce liquidity. Conversely, an unexpected buildup due to overproduction or declining sales could signal inefficiencies in inventory management, or an inability to adjust production schedules to match market demand. This was notably observed during the early stages of the COVID-19 pandemic, when companies across various sectors struggled to align inventory levels with unpredictable consumer behavior, leading to increased storage costs and liquidity pressures. Analyzing such trends involves not only examining inventory turnover ratios, but also understanding the company's supply chain structure, lead times, and demand forecasting accuracy. Deferred liabilities represent another critical component of working capital trends, often obscuring the true extent of short-term obligations. These liabilities can take various forms, including deferred tax obligations, unearned revenue, and accrued expenses. While deferring liabilities may provide temporary relief by postponing cash outflows, it also creates latent risks that can undermine liquidity if these obligations accumulate unchecked. For instance, a company that defers payroll taxes during a financial downturn may face substantial balloon payments when the deferral period ends, exacerbating cash flow challenges. Underwriters and analysts must assess the sustainability of these deferral practices and consider whether the company has a clear plan to manage upcoming payments. Historical examples, such as the financial distress faced by numerous airlines during periods of economic downturn, illustrate how aggressive deferral strategies can mask underlying liquidity risks until they become unmanageable. The interplay between receivables and payables trends also holds significant implications for working capital. A sudden increase in accounts receivable, for instance, might indicate extended payment terms offered to customers or inefficiencies in collections processes. While this may temporarily inflate current assets, it could also strain liquidity if cash inflows are delayed. Conversely, an increase in accounts payable might reflect advantageous credit terms negotiated with suppliers, enabling the company to preserve cash in the short term. However, excessive reliance on extended payment terms can damage supplier relationships and lead to disruptions in the supply chain. This dynamic was evident in the retail sector during the 2008 financial crisis, where major retailers faced supplier pushback after aggressively stretching payment terms to preserve liquidity. To fully understand these trends, analysts must examine the aging schedules of receivables and payables, focusing on patterns such as rising overdue balances or concentration risks among key customers or suppliers. From a theoretical perspective, interpreting working capital trends aligns closely with principles of cash flow management and operational efficiency. The cash conversion cycle, CCC, which measures the time it takes to convert inventory and receivables into cash while accounting for payables, provides a comprehensive framework for assessing working capital performance. A shortening CCC generally indicates improved efficiency, while a lengthening cycle signals potential liquidity issues. However, the CC alone is insufficient without context. For example, a company operating in an industry with long production cycles, such as aerospace manufacturing, may naturally have a longer CCC than a fast-moving consumer goods company. Understanding these nuances requires sector-specific knowledge and a focus on qualitative factors, such as the company's relationships with suppliers and customers, technological investments in inventory management systems, and adaptability to changing market conditions. Interdisciplinary approaches further enrich the analysis of working capital trends. Insights from supply chain management provide valuable context for understanding inventory strategies, while behavioral finance sheds light on managerial decision-making in response to liquidity pressures. For instance, cognitive biases such as overconfidence may lead executives to overestimate future revenues, resulting in excessive inventory accumulation or deferred liabilities that strain working capital. Similarly, Insights from organizational psychology can reveal how internal controls and governance structures influence the effectiveness of receivables and payables management. A company with robust internal controls and a strong culture of accountability is more likely to maintain healthy working capital practices, while weaker governance increases the risk of mismanagement or fraud. Technological advancements are transforming the analysis and management of working capital. Data analytics and artificial intelligence enable real-time monitoring of inventory levels, receivables collections, and payables schedules, providing early warnings of potential anomalies. For example, predictive algorithms can identify patterns of declining customer payment reliability or rising inventory obsolescence, allowing companies to take proactive measures before liquidity issues escalate. Blockchain technology also holds promise for enhancing transparency and efficiency in working capital management by streamlining supply chain transactions and reducing delays in receivables collections. These innovations not only improve the accuracy of working capital forecasts, but also enable more agile responses to changing conditions. Contemporary debates in this field often revolve around the trade-offs between liquidity preservation and operational efficiency. On one hand, maintaining high levels of current assets provides a buffer against unexpected disruptions, enhancing short-term resilience. On the other hand, excessive liquidity can indicate underutilized resources or missed investment opportunities, reflecting inefficiencies in capital allocation. Similarly, while deferring liabilities may improve liquidity in the short term, it raises questions about the sustainability of such practices and their long-term impact on financial stability. These debates highlight the need for a balanced approach to working capital management, integrating both quantitative metrics and qualitative insights to achieve optimal outcomes. Historical case studies underscore the importance of interpreting working capital trends within a broader context. The collapse of major retailers such as Toys R Us illustrates how mismanagement of inventory levels and reliance on deferred liabilities can lead to liquidity crises, even in companies with strong brand recognition and market presence. Similarly, the financial struggles of energy companies during periods of commodity price volatility highlight the risks of misaligned receivables and payables cycles, particularly in industries with long cash conversion periods. These examples emphasize the need for continuous monitoring and adaptive strategies to address emerging challenges in working capital management. By examining working capital trends beyond simple ratios, analysts can uncover hidden risks and opportunities that shape a company's short term. Analyzing the quality of retained earnings is a critical aspect of risk forecasting, as it provides insight into the sustainability and reliability of a company's financial foundation. Retained earnings represent the cumulative profits a company retains after distributing dividends to shareholders, forming a key component of shareholders' equity. However, not all retained earnings are created equal. Distinguishing between earnings derived from core operations and those resulting from non-recurring, unsustainable gains is essential to understanding the financial stability and risk profile of a business. Retained earnings generated from recurring operational activities signal a company's ability to consistently produce value, while those stemming from extraordinary items, asset sales, or one-time tax benefits can mask underlying weaknesses, creating a distorted picture of financial health. At the core of retained earnings analysis lies the relationship between operational profitability and capital reinvestment. Retained earnings should ideally reflect a company's capacity to generate surplus cash flows from its primary business activities and reinvest those funds into growth opportunities, debt reduction, or reserve building. For example, a manufacturing firm that consistently increases its retained earnings through efficient production, cost control, and market expansion demonstrates financial resilience. Conversely, a company that shows significant retained earnings growth due to a one-time asset sale may lack the operational strength to sustain its financial position over time. Analysts must scrutinize the sources of retained earnings by examining the income statement and related disclosures to separate core operational performance from non-recurring events. The theoretical framework for analyzing retained earnings quality includes principles of earnings management, financial reporting, and risk assessment. Earnings management theory emphasizes the potential for companies to manipulate earnings through accounting practices, such as adjusting depreciation schedules, revaluing assets, or timing revenue recognition. While such practices may not always violate accounting standards, they can obscure the true quality of retained earnings. For instance, a company may accelerate revenue recognition to inflate retained earnings in a given period, creating a misleading impression of financial stability. Risk assessment frameworks, such as those derived from credit analysis and bankruptcy prediction models, highlight the importance of retained earnings as a buffer against financial distress. Companies with high-quality retained earnings are better positioned to weather economic downturns, as their financial reserves are backed by reliable, recurring income streams. Practical application of retained earnings analysis involves a multi-layered approach to identifying anomalies and patterns. Analysts should begin by comparing retained earnings trends with revenue and net income growth to ensure alignment. A sharp increase in retained earnings without corresponding growth in operational performance warrants closer examination. For example, if retained earnings surge due to a one-time tax benefit or legal settlement, the sustainability of this growth is highly questionable. Similarly, retained earnings derived from aggressive cost-cutting measures that compromise future revenue potential, such as underinvestment in research and development, may indicate short-termism rather than long-term financial stability. Analysts should also assess the consistency of retained earnings over multiple reporting periods, focusing on whether the company has a history of stable or volatile earnings retention. Interdisciplinary insights enhance the analysis of retained earnings quality by integrating perspectives from behavioral finance, corporate governance, and macroeconomics. Behavioral finance sheds light on managerial incentives and biases that influence earnings retention decisions. For instance, executives driven by performance metrics tied to retained earnings may prioritize short-term gains over sustainable growth, leading to practices that inflate earnings artificially. Corporate governance factors, such as the composition of the board of directors and the strength of internal controls, also play a critical role in ensuring transparency and accountability in retained earnings reporting. A well-governed company with robust oversight is less likely to engage in earnings manipulation, enhancing the reliability of its retained earnings. Macroeconomic conditions further contextualize retained earnings trends by influencing the external environment in which companies operate. During periods of economic expansion, companies may experience robust retained earnings growth driven by increased demand and favorable market conditions. However, during recessions or periods of financial uncertainty, the quality of retained earnings becomes a critical determinant of a company's ability to navigate challenges. For instance, companies that rely heavily on non-recurring gains to bolster retained earnings during downturns may face liquidity crises or erosion of shareholder confidence when those gains dissipate. Contemporary debates in retained earnings analysis often center on the role of accounting standards and the adequacy of disclosure requirements. While frameworks such as International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, provide guidelines for reporting retained earnings, critics argue that these standards allow excessive flexibility, enabling companies to obscure the quality of their earnings. For example, the classification of certain items as non-recurring can be subjective, leading to inconsistent interpretations and comparability challenges. These debates underscore the importance of complementing quantitative analysis with qualitative assessments of management practices, industry norms, and competitive dynamics. Historical case studies provide valuable lessons on the implications of retained earnings quality for financial stability and risk forecasting. The collapse of Enron in the early 2000s serves as a cautionary example of how poor quality earnings, masked by aggressive accounting practices, can lead to catastrophic outcomes. Enron's retained earnings were inflated by non-recurring gains and questionable transactions with special-purpose entities, obscuring the company's deteriorating operational performance. In contrast, companies like Apple Inc. have demonstrated the importance of high-quality retained earnings by consistently generating surplus cash flows from core operations and reinvesting them into innovation and growth. These examples highlight the spectrum of retained earnings quality and its impact on long-term financial health. Technological advancements are transforming the analysis of retained earnings quality by enabling deeper insights and faster detection of anomalies. Data analytics tools can identify patterns and correlations in financial statements, flagging inconsistencies that warrant further investigation. Machine learning algorithms can predict the likelihood of earnings manipulation based on historical data, providing a powerful tool for analysts and underwriters. For example, predictive models might identify companies with unusually high retained earnings growth relative to industry benchmarks, prompting closer scrutiny of their financial disclosures. These tools not only enhance the accuracy of retained earnings analysis, but also improve efficiency, enabling analysts to focus on high-risk cases. By examining retained earnings quality through a rigorous and comprehensive lens, analysts can uncover the underlying drivers of financial performance and assess the sustainability of a company's financial position. This process involves integrating financial analysis, theoretical frameworks, interdisciplinary perspectives, and technological tools to provide a holistic understanding of retained earnings dynamics. Through detailed scrutiny and contextual interpretation, retained earnings quality becomes a critical indicator of financial stability, informing risk, forecasting, and decision-making in an increasingly complex and dynamic business environment. Sensitivity analysis of cash flow in relation to revenue timing and project-based contracts is an essential tool for understanding how delays in project milestones or accounts receivable collections impact a firm's liquidity and financial stability. In project-based industries such as construction, engineering, or software development, cash flow is intricately tied to the timing of revenue recognition, which is often linked to the completion of specific project milestones. Delays in these milestones can create cascading effects, disrupting planned cash inflows and amplifying liquidity stress, particularly for firms operating with narrow working capital margins. Sensitivity analysis enables stakeholders to model these scenarios, quantify the potential impact of delays, and identify stress points where financial or operational risks may become critical. At the foundation of this analysis lies the cash flow cycle in project-based contracts, which typically includes upfront costs, periodic progress payments, and final settlements. Unlike steady revenue streams in product-based businesses, project-based cash flows are inherently uneven, making timing a critical variable. For example, a construction firm might incur significant costs for labor, materials, and subcontractor payments well before receiving progress payments tied to project milestones. Delays in achieving these milestones, whether due to client-side issues, regulatory hurdles, or internal inefficiencies, can leave the firm with a cash flow deficit, forcing reliance on short-term financing or reserve drawdowns. Sensitivity analysis quantifies the extent of this impact by simulating different delay scenarios and evaluating their effect on key metrics such as net cash flow, debt coverage ratios, and liquidity reserves. The theoretical framework for sensitivity analysis is grounded in financial modeling and risk management. Sensitivity analysis involves altering one or more variables, in this case, revenue timing, and observing the resulting changes in cash flow projections. This approach is particularly relevant in project-based contracts, where revenue timing is subject to uncertainty. For instance, a 5-week delay in accounts receivable collections may have a manageable impact under normal conditions, but could become a critical stress point if it coincides with a major capital outlay or debt repayment. By modeling these interdependencies, sensitivity analysis provides a clearer picture of a firm's financial resilience and helps identify thresholds where delays could trigger liquidity crises or covenant breaches. From a practical standpoint, sensitivity analysis requires detailed input data, including project schedules, cost breakdowns, payment terms, and historical performance metrics. Analysts must map out the project timeline, identifying key milestones and associated cash inflows. They should also account for variability in accounts receivable collection periods, which may depend on client payment behavior, contractual terms, and external factors such as economic conditions or industry norms. For example, a government-funded infrastructure project might involve extended payment terms due to bureaucratic processes, increasing the risk of delayed inflows. Sensitivity analysis models should incorporate multiple delay scenarios, ranging from minor deviations to severe disruptions, to capture the full spectrum of potential outcomes. One of the most critical aspects of this analysis is identifying stress points, specific conditions under which delays create the greatest financial strain. These stress points often arise from the interaction of multiple factors, such as high upfront costs, limited access to credit, or tight working capital. For instance, a firm operating in a high-margin but capital-intensive industry may be particularly vulnerable to delays that disrupt its ability to cover fixed costs or meet debt obligations. By pinpointing these vulnerabilities, sensitivity analysis informs decision-making, enabling firms to develop mitigation strategies such as negotiating more flexible payment terms, securing additional credit lines, or optimizing cost structures. Interdisciplinary perspectives enhance the utility of sensitivity analysis by integrating insights from operations management, behavioral finance, and macroeconomics. Operations management provides tools for optimizing project schedules and resource allocation, helping firms reduce the likelihood of delays and their associated cash flow impacts. Behavioral finance sheds light on client payment behaviors, highlighting how factors such as loss aversion or payment inertia influence accounts receivable trends. Macroeconomic conditions, such as interest rate fluctuations or changes in government policy, further contextualize the analysis by shaping the external environment in which projects are executed. Technological advancements are also transforming sensitivity analysis, particularly through the use of data analytics and simulation tools. Advanced modeling software allows analysts to create dynamic, multivariable simulations that capture the complexity of project-based cash flows. These tools can integrate real-time data from project management systems, providing up-to-date insights into milestone progress, cost overruns, and client payment statuses. For example, machine learning algorithms might identify patterns in historical project delays, enabling more accurate predictions of future cash flow disruptions. Blockchain technology is another emerging tool, offering greater transparency and efficiency in contract execution and payment processing, potentially reducing the risk of delayed inflows. Contemporary debates in this field often revolve around the balance between contractual rigidity and flexibility. On one hand, clearly defined payment terms tied to project milestones provide predictability for both clients and contractors. On the other hand, overly rigid terms can exacerbate cash flow challenges in the face of unforeseen delays, particularly if contracts do not account for force majeure events or other disruptions. Some industry experts advocate for more adaptive payment structures, such as milestone-independent progress payments or dynamic payment schedules that adjust based on project conditions. These approaches aim to reduce cash flow volatility while maintaining accountability and performance incentives. Historical case studies illustrate the profound impact of revenue timing delays on cash flow and financial stability. The collapse of Carillion, a major UK construction and facilities management firm, highlights the risks of over-reliance on accounts receivable in project-based contracts. Delays in client payments, combined with rising costs and insufficient working capital reserves, created a liquidity crisis that ultimately led to the firm's insolvency. In contrast, companies that proactively manage cash flow risks through sensitivity analysis and strategic planning, such as Fluor Corporation, demonstrate the importance of resilience and adaptability in navigating complex project environments. By applying sensitivity analysis to cash flow and revenue timing in project-based contracts, firms can gain deeper insights into their financial vulnerabilities and develop more robust strategies for managing liquidity risks. This process involves integrating detailed financial data, theoretical frameworks, interdisciplinary perspectives, and advanced technologies to create a comprehensive and actionable understanding of cash flow dynamics. Through rigorous analysis and scenario modeling, sensitivity analysis becomes an invaluable tool for enhancing financial resilience and ensuring long-term success in an increasingly volatile and competitive business landscape. Assessing the impact of interest rate exposure on financial flexibility requires a detailed understanding of how variable rate debt, hedging strategies, and market conditions influence a principal's cost of capital and long-term financial stability. Variable rate debt, unlike fixed rate obligations, ties interest payments to market indices such as the London Interbank Offered Rate or the Secured Overnight Financing Rate. This structure introduces an inherent sensitivity to fluctuations in interest rates, which can create both opportunities and risks depending on the broader economic environment. In rising interest rate scenarios, firms with significant variable rate exposure face increased borrowing costs, potentially straining liquidity, compressing margins, and reducing financial flexibility. Evaluating these dynamics is critical for understanding the resilience of a principal's capital structure and the strategic measures employed to mitigate exposure. At the core of this analysis lies the relationship between interest rate movements and the cost of capital. The cost of capital reflects the expense of funding operations and investments, encompassing both debt and equity financing. Variable rate debt amplifies uncertainty in this cost, as periodic adjustments in interest payments can disrupt cash flow planning. For instance, a firm with a significant portion of its debt portfolio tied to variable rates may experience rapid increases in financing costs during a tightening monetary cycle, diverting resources from operational or growth initiatives. Historical instances, such as the interest rate hikes of the late 1970s and early 1980s, underscore the severity of these risks, as companies with heavy variable rate exposure struggled to service debt and maintain solvency under escalating rate conditions. Sensitivity analysis of variable rate obligations provides insight into the thresholds at which rising rates compromise financial flexibility, helping stakeholders identify critical stress points. Hedging strategies play a pivotal role in managing interest rate exposure. Financial derivatives such as interest rate swaps, caps, and collars enable firms to stabilize their cost of debt by effectively converting variable rate obligations into fixed-rate instruments or capping the maximum rate paid. For example, an interest rate swap involves an agreement to exchange cash flows between fixed and floating rates, providing predictability in interest expense while retaining flexibility. Caps set a ceiling on interest payments, offering protection against extreme rate spikes while allowing the firm to benefit from lower rates during stable or declining environments. The choice of hedging strategy depends on the firm's risk tolerance, market outlook, and liquidity needs, as well as the cost and complexity of implementing these instruments. Detailed analysis of hedging arrangements requires evaluating not only their effectiveness in mitigating exposure, but also their impact on overall financial performance, including potential trade-offs such as counterparty risk and opportunity cost. From a theoretical perspective, interest rate exposure analysis is grounded in financial economics and risk management principles. The Modigliani-Miller theorem highlights the neutrality of capital structure in an idealized world, but real-world imperfections such as tax advantages of debt and the asymmetric impact of interest rate volatility on cash flows necessitate a more nuanced approach. Risk management frameworks emphasize the importance of aligning hedging strategies with the firm's broader financial objectives, avoiding excessive complexity or speculative behavior that could exacerbate rather than mitigate exposure. For example, a firm engaging in speculative derivative positions beyond its actual exposure may introduce additional risks unrelated to its core operations, undermining the intended protective benefits of hedging. The practical application of interest rate exposure assessment involves a comprehensive review of the principal's debt portfolio, focusing on the proportion of variable rate versus fixed rate obligations, the maturity profile of outstanding debt, and the contractual terms governing interest adjustments. Analysts should also evaluate the firm's liquidity reserves and access to alternative financing sources, as these factors influence the ability to absorb rate shocks. For instance, a firm with robust cash reserves or untapped credit lines is better positioned to manage rising interest costs than one reliant on short-term liquidity. Scenario modeling is a critical tool in this analysis, simulating the impact of rate increases on key financial metrics such as debt service coverage, earnings before interest, taxes, depreciation, and amortization, and free cash flow. These simulations provide a detailed view of the firm's capacity to maintain financial stability under adverse conditions, informing both internal decision-making and external risk assessments. Interdisciplinary insights further enhance the analysis of interest rate exposure and its impact on financial flexibility. Behavioral finance highlights how managerial biases and incentives influence decision-making around debt structure and hedging. For example, overconfidence bias may lead executives to underestimate the likelihood or severity of rate increases, resulting in insufficient hedging or over-reliance on variable rate debt. Macroeconomics provides essential context for understanding interest rate trends, including the role of central bank policy, inflationary pressures, and global capital flows. For instance, tightening monetary policies aimed at curbing inflation typically result in rising rates, while periods of economic stimulus or quantitative easing may keep rates low, influencing the relative attractiveness of variable versus fixed rate financing. Technological advancements are transforming interest rate exposure analysis through the use of data analytics, predictive modeling, and real-time monitoring tools. Advanced algorithms can analyze historical rate patterns, forecast future movements, and assess their potential impact on specific debt portfolios. Real-time monitoring systems enable firms to track market indices and adjust hedging positions dynamically, enhancing responsiveness to changing conditions. For example, artificial intelligence-driven platforms might identify optimal hedging strategies based on a combination of market data, firm-specific metrics, and macroeconomic indicators, reducing the time and cost associated with traditional analytical methods. Contemporary debates surrounding interest rate exposure often center on the balance between cost efficiency and risk mitigation. While variable rate debt typically offers lower initial costs compared to fixed rate alternatives, this advantage must be weighed against the potential for increased volatility in rising rate environments. Some experts argue that firms should prioritize fixed rate financing to ensure predictability and stability, particularly during periods of economic uncertainty. Others advocate for a balanced approach that incorporates both fixed and variable components, supplemented by targeted hedging to achieve an optimal blend of flexibility and protection. These debates highlight the importance of tailoring interest rate strategies to the specific needs and risk profile of the firm, rather than adopting a one-size-fits-all approach. Historical case studies illustrate the significant impact of interest rate exposure on financial outcomes. The 2008 financial crisis, for example, revealed how excessive reliance on short-term and variable rate debt contributed to liquidity crises for many firms, particularly those in highly leveraged sectors such as real estate and financial services. In contrast, companies with diversified debt structures and proactive hedging strategies were better able to navigate the turmoil, demonstrating the value of prudent interest rate management. Similarly, the recent shifts in global interest rates following the COVID-19 pandemic have underscored the importance of maintaining flexibility and adaptability in an era of heightened economic uncertainty. By deeply analyzing variable rate debt exposure, hedging strategies, and their influence on financial flexibility, stakeholders can gain critical insights into a principal's ability to navigate rising interest rate environments and maintain long-term viability. This process involves integrating detailed financial analysis, theoretical principles, interdisciplinary perspectives, and technological tools to create a robust framework for risk assessment and strategic decision-making. Through rigorous evaluation and continuous adaptation to changing conditions, firms can effectively manage interest rate exposure, safeguarding their financial stability and ensuring resilience in an increasingly dynamic economic landscape. Dissecting bond principal liquidity using quick assets analysis requires a meticulous examination of the most liquid components of a principal's balance sheet, including cash, marketable securities, and receivables. These quick assets are the first line of defense in addressing immediate financial obligations and provide critical insights into the principal's capacity to meet short-term liabilities under varying economic conditions. Unlike broader liquidity measures such as the current ratio, which includes inventory and other less liquid assets, the analysis of quick assets focuses solely on resources that can be converted into cash quickly and without significant loss of value. This targeted approach is essential for forecasting potential liquidity gaps, particularly in high-stress scenarios where the timing and reliability of asset conversion are paramount. The foundation of quick assets analysis lies in understanding the composition and quality of each component. Cash is the most liquid asset and serves as the baseline for immediate liquidity. However, its adequacy must be evaluated relative to operational demands, debt service requirements, and potential contingencies. Marketable securities, such as government bonds or high-grade corporate debt, provide a secondary liquidity source, offering the advantage of rapid convertibility with minimal price volatility under normal market conditions. Yet, their reliability can be compromised during periods of economic distress or market dislocation, as was evident during the 2008 financial crisis, when even highly rated instruments faced liquidity challenges. Receivables, the third pillar of quick assets, represent cash inflows tied to credit sales and contractual agreements. While receivables are often viewed as a near-liquid asset, their collectability depends on the financial health of counterparties and the terms of the underlying agreements, requiring detailed scrutiny to assess timing and risk of default. The theoretical framework for analyzing quick assets incorporates principles from financial liquidity theory, credit risk assessment, and operational efficiency. Liquidity theory emphasizes the role of quick assets in bridging the gap between cash inflows and outflows, highlighting their importance in maintaining financial equilibrium. Credit risk assessment adds a layer of complexity by evaluating the quality of receivables, focusing on factors such as counterparty creditworthiness, payment history, and contractual terms. Operational efficiency further informs the analysis by linking the management of quick assets to broader business processes, such as cash flow optimization and working capital management. For instance, firms with efficient billing and collections practices are better positioned to convert receivables into cash promptly, reducing the risk of liquidity shortfalls. Practical application of quick assets analysis begins with a detailed breakdown of the principal's balance sheet, isolating cash, marketable securities, and receivables from other current assets. Analysts must evaluate the composition and stability of each category, identifying potential vulnerabilities or concentrations that could impact liquidity. For example, an over-reliance on receivables from a single large customer poses a significant risk if that customer's financial condition deteriorates. Similarly, a heavy allocation to marketable securities with long durations or high credit risk increases exposure to market fluctuations and liquidity constraints. Stress testing is a critical tool in this process, simulating scenarios such as delayed collections, declining asset values, or unexpected cash outflows to identify points of vulnerability and forecast liquidity gaps. Economic conditions play a central role in shaping the reliability of quick assets, particularly during periods of volatility or recession. In a rising interest rate environment, for instance, the value of fixed-income marketable securities may decline, reducing their liquidity potential. During economic downturns, the risk of receivable defaults increases, particularly for principals operating in industries with high credit sensitivity or cyclical demand. These dynamics underscore the importance of contextualizing quick assets analysis within the broader macroeconomic environment, incorporating factors such as interest rate trends, credit market conditions, and sector-specific risks. For example, a construction firm reliant on receivables from long-term contracts may face heightened liquidity pressures during a housing market contraction, as clients delay payments or renegotiate terms. Interdisciplinary perspectives enhance the analysis of quick assets by integrating insights from behavioral finance, macroeconomics, and operational management. Behavioral finance sheds light on the decision-making processes of managers and counterparties, highlighting how cognitive biases or market sentiment influence asset allocation and receivables performance. Macroeconomics provides essential context for understanding how systemic factors such as inflation, monetary policy, and global capital flows impact the liquidity of marketable securities and the collectability of receivables. Operational management contributes practical tools for optimizing cash flow and working capital, such as implementing dynamic credit terms, leveraging technology for real-time receivables tracking, and establishing contingency plans to address liquidity shortfalls. Technological advancements are transforming quick assets analysis by enabling more granular and dynamic insights. Data analytics tools allow firms to monitor receivables aging, marketable securities performance, and cash flow patterns in real time, identifying emerging risks and opportunities with greater precision. Machine learning algorithms can predict receivable default probabilities based on historical payment behavior, industry trends, and macroeconomic indicators, providing actionable intelligence for risk mitigation. Blockchain technology offers additional potential for enhancing the reliability of receivables by creating transparent and immutable records of transactions, reducing disputes and improving payment efficiency. Contemporary debates in quick assets analysis often center on the balance between maintaining liquidity and optimizing asset utilization. While holding substantial cash reserves provides a buffer against unexpected shocks, it may also signal inefficiencies in capital allocation, as idle cash generates minimal returns. Similarly, while marketable securities enhance liquidity, Excessive reliance on these assets may expose firms to interest rate or market risks, particularly in volatile economic conditions. These debates highlight the need for a strategic approach to quick assets management, balancing liquidity needs with financial performance objectives and risk tolerance. Historical case studies illustrate the critical importance of quick assets in maintaining liquidity under stress. The collapse of Lehman Brothers in 2008 underscores the consequences of over-reliance on illiquid assets and insufficient cash reserves, as the firm's inability to meet short-term obligations triggered a broader financial crisis. In contrast, companies such as Johnson & Johnson have demonstrated the value of maintaining a robust quick assets base, leveraging cash and high-quality marketable securities to weather economic downturns and seize growth opportunities. These examples highlight the spectrum of outcomes associated with quick assets management and the importance of rigorous analysis in forecasting liquidity gaps. By performing granular analyses of quick assets and integrating these insights with broader financial and operational considerations, stakeholders can develop a comprehensive understanding of liquidity dynamics and their implications for financial stability. This process involves evaluating the composition, quality, and reliability of cash, marketable securities, and receivables, while accounting for economic conditions, counterparty risks, and operational efficiency. Through rigorous and dynamic analysis, quick assets become a powerful tool for forecasting liquidity gaps and supporting informed decision-making in an increasingly complex and volatile financial landscape. Detecting fraud and misrepresentation in financial reporting for surety applications is a critical process that safeguards underwriters from assuming undue risk based on distorted financial data. Financial misrepresentation can take many forms, including revenue recognition manipulation, fictitious assets, and improper expense capitalization, each of which undermines the reliability of financial statements and can lead to significant financial losses for sureties. Identifying these practices requires a combination of forensic accounting techniques, robust analytical frameworks, and an understanding of common fraud schemes within specific industries. In the context of surety applications, where financial stability and liquidity are key considerations, uncovering misrepresentation is not only about protecting the surety's interests, but also about ensuring the broader integrity of the financial system. Revenue recognition manipulation is one of the most prevalent forms of financial misrepresentation and involves altering the timing or criteria for recognizing revenue to inflate earnings artificially. This can be achieved through methods such as premature revenue recognition, fictitious sales, or aggressive accounting for long-term contracts. For example, a construction firm applying for a surety bond might overstate revenue by recognizing income from contracts that have not met the requisite performance milestones. This practice inflates earnings and retained earnings, creating a misleading picture of financial health. Analysts must scrutinize revenue trends alongside contractual terms to detect inconsistencies, such as revenues that appear disconnected from the progress of underlying projects, or sudden surges in revenue during periods of financial distress. The use of analytical procedures, such as comparing revenue growth with industry benchmarks or examining deviations in gross margins, can provide early warning signs of manipulation. Fictitious assets represent another common method of financial misrepresentation and involve the inclusion of non-existent or overvalued assets on the balance sheet. This type of fraud is designed to inflate the firm's asset base, enhance liquidity ratios, or offset liabilities to present a stronger financial position. For instance, a company may create fictitious inventory entries or inflate the valuation of existing assets to bolster working capital figures. Historical cases, such as the fraud at Parmalat, illustrate how fictitious assets can go undetected for extended periods, as fraudulent documentation and complicit auditors obscure the truth. Detecting such schemes requires a granular review of asset categories, including physical verification of inventory, appraisal of fixed assets by independent third parties, and scrutiny of supporting documentation such as invoices or purchase agreements. Unusual asset classifications, sudden increases in asset balances without corresponding operational growth, or discrepancies in subsidiary accounts may signal the presence of fictitious assets. Improper expense capitalization is a method of fraud that shifts expenses from the income statement to the balance sheet, artificially inflating profitability. By capitalizing operating expenses as long-term assets, firms can reduce current period expenses and enhance earnings, creating a deceptive appearance of financial strength. This practice is particularly relevant in industries with significant capital expenditures, such as construction or manufacturing, where the distinction between operating expenses and capital investments can be blurred. Analysts must evaluate the capitalization policies disclosed in financial statements, comparing them with industry norms and generally accepted accounting principles, GAAP. Red flags include disproportionate increases in capitalized costs relative to revenue, inconsistent application of capitalization criteria, or discrepancies between operational activity and asset growth. In-depth trend analysis and cross-referencing with operational data, such as production volumes or project progress, can help uncover irregularities. Theoretical frameworks such as the fraud triangle provide a foundation for understanding the motivations and conditions that lead to financial misrepresentation. The fraud triangle posits that fraud arises from a combination of pressure, opportunity, and rationalization. In the context of surety applications, pressure often stems from financial distress or the need to secure favorable bond terms. Opportunity arises from weak internal controls, insufficient oversight, or complex financial structures that obscure fraudulent activities. Rationalization, the third element, reflects the mindset of those committing fraud, who may justify their actions as temporary measures to buy time or protect jobs. Understanding these dynamics enables analysts to identify potential fraud risks, focusing on firms with high financial leverage, declining performance, or governance weaknesses. Interdisciplinary insights enhance the detection of financial misrepresentation by integrating perspectives from forensic accounting, behavioral finance, and data analytics. Forensic accounting techniques, such as ratio analysis, trend examination, and the use of Benford's law to detect anomalies in numerical data, provide powerful tools for identifying irregularities. Behavioral finance contributes an understanding of how cognitive biases and managerial incentives influence financial reporting, shedding light on the conditions under which fraud is most likely to occur. Data analytics and artificial intelligence further enhance fraud detection by automating the analysis of large datasets, identifying patterns or anomalies that would be difficult to detect manually. For example, machine learning algorithms can flag inconsistencies between reported revenues and cash flows, or identify unusual correlations between financial metrics and external indicators such as market conditions or competitor performance. Contemporary debates in this field often revolve around the adequacy of regulatory frameworks and the role of auditors in detecting financial misrepresentation. Critics argue that current accounting standards and audit practices may fail to address the complexities of modern fraud schemes, particularly those involving multinational corporations or sophisticated financial instruments. Proposals for increased transparency, enhanced auditor independence, and the use of technology in auditing processes reflect ongoing efforts to strengthen the reliability of financial reporting. However, these measures also raise questions about the cost and feasibility of implementing more rigorous standards, as well as the potential for unintended consequences, such as discouraging innovation or increasing compliance burdens. Historical case studies provide valuable lessons on the methods and consequences of financial misrepresentation. The collapse of Enron serves as a landmark example of revenue recognition manipulation, where the use of special purpose entities and aggressive accounting practices created the illusion of profitability while concealing massive liabilities. Similarly, the fraud at WorldCom highlighted the use of improper expense capitalization to inflate earnings, ultimately resulting in one of the largest bankruptcies in corporate history. These cases underscore the importance of vigilance and thorough analysis in uncovering financial misrepresentation, as well as the systemic risks posed by undetected fraud. By exploring methods to uncover financial misrepresentation in surety applications, analysts can protect stakeholders from undue risk and enhance the integrity of the financial system. This process requires a combination of technical expertise, theoretical knowledge, and practical tools, applied within a framework of rigorous scrutiny and professional skepticism. Through detailed examination of revenue recognition, asset quality, and expense practices, and by leveraging interdisciplinary insights and technological advancements, The detection of fraud and misrepresentation becomes a critical component of effective financial analysis and risk management. Integrating financial covenants and external credit ratings in risk assessment provides a multidimensional view of a firm's financial health and potential vulnerabilities. Financial covenants, embedded in loan agreements, serve as contractual safeguards designed to protect lenders by imposing performance benchmarks and limiting the borrower's financial actions. These covenants typically include requirements such as maintaining specific debt-to-equity ratios, minimum interest coverage ratios, or maximum leverage thresholds. External credit ratings, issued by agencies such as Moody's, S&P Global, or Fitch, evaluate a borrower's overall creditworthiness, reflecting the likelihood of default based on a combination of financial metrics, qualitative assessments, and macroeconomic conditions. Together, these tools form a complementary framework for assessing risk, with covenants offering granular, real-time indicators and credit ratings providing a broader, market-based perspective. The interplay between financial covenants and credit ratings becomes especially critical in identifying scenarios where covenant breaches may signal deeper financial instability. Breaching a financial covenant, such as exceeding a maximum leverage ratio or failing to maintain sufficient liquidity, often triggers lender responses, ranging from renegotiation to acceleration of debt repayment. These breaches are not isolated events. They frequently indicate broader operational or financial stress. For instance, a declining interest coverage ratio might reflect not only a temporary earnings shortfall, but also structural issues such as deteriorating margins, increased borrowing costs, or weakening competitive position. External credit ratings, meanwhile, provide a parallel signal, as downgrades often correlate with covenant breaches. However, the causality can flow in both directions. While a downgrade might reflect covenant-driven liquidity pressures, the breach itself can precipitate a downgrade by signaling heightened risk. A critical element of this analysis involves understanding the thresholds and triggers embedded in financial covenants. Unlike credit ratings, which are inherently subjective and forward-looking, covenants are precise and binary. They establish specific conditions that must be met with clear consequences for non-compliance. This precision makes covenants valuable early warning indicators. For example, a borrower required to maintain a debt-to-EBITDA ratio below 3.0 might demonstrate compliance at the start of a loan term, but gradually approach the threshold due to rising debt or declining earnings. Sensitivity analysis of these thresholds helps forecast breach scenarios, enabling lenders and underwriters to evaluate the likelihood and potential impact of noncompliance. Moreover, covenant trends across industries and economic cycles offer insight into systemic risk, as shifts in covenant structures often reflect changing market conditions. For instance, looser covenants, commonly referred to as covenant-light agreements, became prevalent during periods of abundant liquidity, such as the years leading up to the 2008 financial crisis, only to tighten sharply as credit markets contracted. External credit ratings complement covenant analysis by capturing risks that may not be immediately apparent in covenant compliance metrics. Ratings incorporate qualitative factors such as management quality, industry outlook, and macroeconomic trends, as well as quantitative measures like cash flow stability and debt maturity profiles. For instance, a firm might remain compliant with its covenants while experiencing a gradual erosion in credit quality due to competitive pressures or declining market share. A rating downgrade in such a scenario serves as an early signal of weakening financial health, prompting stakeholders to reassess the firm's risk profile. Conversely, covenant breaches in the absence of rating downgrades warrant scrutiny to determine whether the breach is an isolated technical issue or indicative of broader concerns not yet reflected in the rating. The theoretical framework for integrating covenants and credit ratings in risk assessment is grounded in credit risk modeling and financial contracting theory. Credit risk models, such as the Merton model, emphasize the relationship between asset volatility and default probability, highlighting how deteriorating financial performance increases the likelihood of covenant breaches and rating downgrades. Financial contracting theory explores the role of covenants in mitigating agency problems by aligning the interests of borrowers and lenders. Covenants act as monitoring tools, reducing information asymmetry by requiring borrowers to adhere to specific financial disciplines. When combined with credit ratings, which incorporate external and market-driven evaluations, these mechanisms create a layered approach to risk assessment, balancing precision and breadth. Practical application involves detailed analysis of financial statements, loan agreements, and rating agency reports. Analysts must identify key covenants, assess the borrower's historical compliance, and model future scenarios to evaluate breach risk. This includes stress testing financial metrics against adverse conditions, such as revenue declines, cost increases, or interest rate hikes. For example, a firm operating with narrow interest coverage might breach its covenant if borrowing costs rise sharply, even if its overall financial condition remains stable. At the same time, analysts should monitor credit rating changes, paying particular attention to rating outlooks and watchlist statuses, which often precede formal upgrades or downgrades. Cross-referencing these findings with covenant data provides a more comprehensive understanding of risk, enabling proactive decision-making. Interdisciplinary insights enhance the analysis by integrating perspectives from behavioral finance, macroeconomics, and corporate governance. Behavioral finance sheds light on managerial behavior under covenant constraints, highlighting how the fear of breach consequences can drive suboptimal decisions, such as delaying necessary investments or engaging in earnings management. Macroeconomic factors, such as interest rate trends, inflation, and GDP growth, shape the broader environment in which covenants and credit ratings operate, influencing both compliance likelihood and rating stability. Corporate governance further informs the analysis by examining the role of board oversight, executive incentives, and risk management practices in mitigating covenant breach and rating downgrade risks. For instance, firms with strong governance structures are more likely to maintain financial discipline and transparency, reducing the probability of adverse outcomes. Technological advancements are transforming the integration of financial covenants and credit ratings in risk assessment. Data analytics and machine learning enable real-time monitoring of covenant compliance, leveraging predictive algorithms to forecast breach scenarios based on historical trends and external variables. These tools can also analyze rating agency methodologies, identifying patterns and correlations that enhance the predictive accuracy of rating changes. Blockchain technology offers additional potential, particularly in the context of loan agreements, by creating immutable records of covenant terms and compliance metrics, reducing disputes and improving transparency. Contemporary debates often center on the adequacy of covenants and ratings as risk assessment tools. Critics argue that covenants, while precise, can be overly rigid, failing to account for temporary fluctuations or non-financial factors that influence risk. Similarly, credit ratings face scrutiny for their perceived lag in reflecting rapid changes in borrower conditions, as well as potential conflicts of interest in issuer-paid models. These debates underscore the importance of using covenants and ratings as complementary rather than standalone tools, integrating them within a broader risk management framework that accounts for both quantitative and qualitative dimensions. Historical case studies illustrate the significance of combining covenant and credit rating analysis to identify and mitigate risk. The 2008 financial crisis highlighted the dangers of relying on overly lenient covenants and inflated credit ratings, as many firms breached covenants or faced downgrades only after their financial conditions had significantly deteriorated. In contrast, firms that proactively monitored both metrics were better positioned to renegotiate terms, strengthen liquidity, and maintain stability. These lessons underscore the value of a proactive and integrated approach to risk assessment. By studying the interplay between financial covenants and external credit ratings, stakeholders can gain deeper insights into a borrower's financial health and resilience. This process involves integrating precise real-time covenant data with broader market-driven credit evaluations, supported by rigorous analysis, interdisciplinary insights, and advanced technologies. Through continuous monitoring and scenario modeling, this approach enhances the ability to anticipate and respond to financial risks, safeguarding both lenders and borrowers in an increasingly complex economic landscape.